Welcome back to another Meet Kevin report. We're on episode 90. It is Saturday, April 22nd. Biden within the next month is expected to sign another executive order ramping up again limitations on exports to China and investments by American businesses into China. This is leading Taiwan to actually come out and suggest, hey, y'all might want to talk down the extremeness a little bit because we're worried about getting invaded over here and y'all are making it worse. Biden's new executive order is supposed to come with support of other G7 countries and specifically focus on quantum computing and AI restrictions. We look at flows for the stock market in April. $12.6 billion went right into exchange traded funds, many of them long funds, as opposed to the ultra short cash style funds that we've seen people flow into throughout 2022. Those actually had their first monthly outflow since January of this year when we had a big rally in tech stocks. And it's starting to appear like people are starting to move from those ultra short positions into the more long-based positions, stocks they want to hold for the next, say, 10, 15, 20 years. Now, remember what's interesting about ETFs is when you hold an ETF and you hold that ETF, hold on one sec. There we go. You hold that ETF ticker symbol. What ends up happening is if the ETF manager rebalances within it in a certain way, and you go from having a potential capital gain, you could actually have the ETF manager not pass any capital gain on to you if they trade the ETF in a certain way. This makes holding an ETF ticker symbol potentially really tax advantageous over like a mutual fund or just holding the shares yourself. So kind of a pretty neat tax loophole a lot of people are taking advantage of. But again, you need a manager whom, when there are gains, actually sets up the structure appropriately. So next, we're going to talk about the consumer, and then we've got stuff to talk about with the Fed and politics and a lot of different things to cover. Should be pretty fun. So we'll get started with the consumer here in about 10 seconds here. We'll go right into the what's going on with the consumer, and it's pretty wild out there. So cheers to your Saturday morning. All right, here we go. While Gallup polls finds that 50% of Americans find that their financial situation is now worse off than it was a year ago. That is the most negative read since the Great Recession. The Consumer Conference Board, a leading indicator on the economy, also just had an unexpectedly sharp drop, hitting its lowest level since November of 2020, its 12th decline in a row, and the longest stretch of declines that we've had since, guess when? Also the Great Recession. Subprime lending is tightening, and lenders are ramping up car repossessions, so much so that the Wall Street Journal finds that it's, quote, Christmas for car repossession companies, though even they are having struggles finding enough workers to actually fulfill the demands of car repossessions. So, what's happening with the consumer today? And what does it mean about a potential recession? Because remember, the consumer makes up over 2/3 of our entire economy. That's different in a country like China, where the consumer only makes up about 30% of the economy. Here in America, vast majority of our economy and its economic power and its growth is based on your spending. So, what's happening with everyone spending in America, and how similar does it sound to you? Well, let's talk about it. First, there are many different segments we're going to break down here on the consumer, and the first is going to be the trade down. We've known this since the beginning of 2022. People are spending less for the same product when they can. But there's an interesting trade-off here. See, higher income people might be spending more money at companies like Costco and Sam's Club as opposed to, let's say, Whole Foods. Then you have middle income customers or lower income customers who might originally be spending money at Costco and Sam's Club who are now moving down to potentially Walmart. And then you have lower income individuals who are trading at or buying at Walmart who are potentially trading down to Dollar General. The problem is at some point you hit a bottom. You just can't trade down anymore. Not only can you not trade down the store you're buying at, whether it's Walmart instead of, say, Target, but now it's the Dollar General instead of even Walmart. But once you're already at the Dollar General, you kind of hit rock bottom, and it's difficult to keep trying to save money on stuff. So what ends up happening is you have less money available to buy discretionaries. You spend more money on the things that you need, whether it's medicine or food, groceries, whatever. Problem with that is ordinarily people are able to move from like a branded product like a Tide detergent or a Cheerios to maybe something cheaper like an O's brand or whatever of a more generic cereal. But again, the problem is for lower income consumers, you hit a floor. At some point, you're already using the discount product. And so Dollar General, for example, is trying to come up now with its own private label brands. And this blows my mind because now we're literally talking about Dollar General realizing that there are people who are wanting to trade down from the brands that are in Dollar General to a Dollar General brand. That's weird. It's problematic, though, not for wealthier people or even middle-class people who actually have room to move down. It's problematic for the poorest of the poor, specifically those for whom utility costs and high rents have really been slaying their ability to get ahead in life. It's becoming even more difficult for them to stay ahead. While at the same time, what's happening with richer folks? Well, look at LVMH, Sephora, your Louis Vuitton. No sign of a slowdown here. And what's weird is you didn't have a slowdown in September of 2008 either. LVMH spending was still strong, and the CEO in an earnings call from September of 2008 told us there was no decline in spending from richer folks. And so it seems that one of the earliest indicators that we get in a consumer-led recession is the lowest income tiers start suffering first. But the question is, will the lowest income tier actually lead the entire economy into a recession? And that's much less clear. Generally, what you need to see the middle and upper tier stop spending to actually be driven into a recession. For example, the richer folks didn't stop spending at LVMH until the second quarter of 2009. That's when the Federal Reserve was already printing money. And so it's no surprise that LVMH stock didn't actually fall when their revenue hit a floor in Q2 of 2009, which would have been reported around July of 2009. Instead, their stock was rising. So in a weird way, when you go back to 2008 and 9, and if you look at sort of the wealthier cohort of stocks, well, those stocks may have gotten hit with the initial impression of the recession, and they certainly did from 2007 to 2008. But when earnings actually hit a bottom, the stocks had already meaningfully recovered and continued to recover from there. And so it's interesting to see this deviation between the various different stock performances and what's actually happening with consumer spending. A lot of stocks right now are down, but consumer spending in some segments is still doing quite well. We look at companies like Ulta, which apparently has incredibly high pricing power, and their stock has actually been killing it. And so it makes you wonder also, wait a minute, now we get these misleading signals of what actually is happening. And that's actually where things really get fascinating when we consider what's happening with consumers. Look at, for example, when we zoom in to boomers versus millennials. We're seeing a lot of spending growth led by millennials and Gen Z. Consider this. At American Express, millennials and Gen Z increased their spending 28%. Boomers increased their spending 8%. Now, maybe that's because boomers own the majority of assets. After all, millennials really own about 2.3% of all of the stock that exists, and boomers and Gen X own like 56.3%, plus another 25.3% for the Gen X. So combined, the vast majority of stocks that are out there, just over 80%, are owned by boomers and Gen X. And maybe they felt their wealth decline, and therefore they're not spending as much. But millennials and Gen Z didn't have much wealth to start with, and maybe there's a choice of, hey, we just went through a disproportionately long COVID lockdown for a younger person, right? Well, 2 years out of a 20-year-old's life is 10%. 2 years out of a 60-year-old person's life is a third of a tenth of 10%, so about 3%, right? So a huge difference. So maybe what you're seeing happening is sort of this deviation in the age of spend as well. And this kind of makes for, again, a blurry picture of what's going on with the consumer, because if older folks are spending less because they're like, hey, going into recession. We've been down this rodeo before. We remember the 70s. We remember the 80s. We remember '08. We remember .com. You know what? We're going to hit the brakes a little bit and spend a little less. And we've already seen our 401ks and our stocks go down. Fine. But on the other hand, who's stepping in to spend more? Gen Z and and millennials, who are also getting paid more at a lot of the jobs that they're working. After all, lower income jobs are the ones seeing the largest wage gains on a nominal basis. And if they're able to spend that money on travel and entertainment, then maybe that's why we're still seeing consumers as an aggregate still somewhat propped up. But it's interesting because if you also go a little bit deeper into different kinds of businesses and business spending, you have almost what feels like the opposite. The smaller and more immature companies, like almost like the younger folks, but in the business world, they're only spending 6% more year over year at American Express, whereas larger corporations are spending 34% more year over year, which is interesting because when I segment this and I try to understand this, I think to myself, okay, so what you have are wealthier people still spending money at companies like whether it's L'Oreal, LVMH, larger corporations, still spending money. So the wealthy and the folks investing for the next 10 years, the larger businesses, they're spending money like crazy. Then on the other hand, you've got younger folks who are like, I'm making more money on an hourly basis, whether it's a real wage gain or not. And so I'm going to spend more money and I'm going to spend it on travel and entertainment because we got to live a little. And then there are some spots in between where we're looking saying, okay, but some of the smaller businesses or like the really poor who are, much more paycheck to paycheck and are having to shop between various different stores, whether it's Dollar General, jumping over to Five Below, whatever, to try to get through some of this inflationary pain that we're seeing. Are those sectors really going to hit the economy? Well, nobody really knows. And so that's the big question. And what I like to try to do to break this down is I go, okay, well, what's going on with savings? Because really, ultimately, we need to see savings decline for people at all levels to finally say, all right, let's rein in our spending. So in other words, let's see companies issue less buybacks and people have less money in their savings account and more unemployment. Those are the things that we should see as conditions for a recession. Yeah, wait a minute. What are we actually seeing? Well, we're not seeing joblessness go up, even though that's a lagging indicator. We're actually seeing stock buybacks increase at companies, more buybacks planned in the next 12 months than in the last 12 months, which is remarkable. And this was mind-blowing, absolutely mind-blowing. Bank of America says customers have a 53% higher balance in their checking account than they did before the pandemic. But it's not just that, because that's fine. Like we could still have excess savings left over, right? But that's trending down, right? That's going to evaporate, right? This was mind-blowing. Look at this from Bank of America. Here we go. Consumers are being more careful in their use of cash. However, they've got 53% more cash in their accounts than they did pre-pandemic. But then listen to this line right here. From peak last year, consumer savings fell down a little bit all the course of the year. And it's built back up in the first part of 2023. What? Think about what that means for a moment. That means when it comes to the consumer, we could not be getting a more blurry picture. We thought savings would blow up and then would collapse and then we would go into recession. But that's not actually what happened. Savings blew up, drew down in 2022, and now they're coming up again at higher levels now than where they were before the pandemic. So wait a minute. How do we reconcile all of this data? Because this is pretty confusing. And yet still it makes us wonder, what does this mean for a recession? Because we're supposed to see unemployment go up, because if somebody gets laid off, they're going to stop spending, right? Well, maybe not, because if you get laid off, and then you go buy some Ulta and Sephora makeup, and then you get another job, and then you go right back to spending, maybe the JOLTS, that is the job openings and labor turnover survey, actually shows us there's a huge cushion, like a huge safety net blanket of like, lost your job? No problem. Come work over here. And in a weird way, when we put this together, we go, wait a minute, maybe the consumer can actually get through whatever this period of time is that we're in, call it recession or not. I mean, consider what we just learned. We learned that millennials and Gen Z are spending more money. Big businesses are spending more money. We know that average savings accounts are actually growing again at the start of 2023, totally against expectations. We know that the lowest 20% of Americans are spending less where they can. But the question is, how much does that segment matter towards GDP? So when we write that down, the answer is probably very little. In fact, we could probably Google quartile contribution to GDP. And my guess is the top 4 quartiles contribute substantially more than the lowest quartile. So we'll do some searching for that and see if we could get some answers on that. But I think it's very interesting. So in the meantime, let's see here. Which incomes contribute most to GDP? Let's see if we could find it. I'm sure we could find it here. GDP contribution by sector, we don't care about. We want by income. That's what we want. GDP contribution by income. Anyway, but let's just go with the assumption that the vast majority of GDP contribution is from those of the highest income brackets. But when we put this together, we're kind of scratching our heads going, does this sound like a recession? And really, when we look and we say, well, we don't have the unemployment yet, but we know that lags. We still have the high income spending, right? So if we have the high income spending, but that's also a lagging indicator, does that tell us anything about recession? Well, probably the best leading indicator would be savings and job losses, but both savings are rising and job losses are relatively stable. So I'm somewhat confused by this picture of the consumer. The picture of the consumer shows pain at the lowest levels, the levels that can't trade down any lower, the levels that have the highest exposure to rent, and also potentially subprime auto loans or other subprime loans, like using credit cards. Credit cards, in theory, are a form of subprime lending because you can't get a loan against your home or some kind of other lower interest rate debt. So when we try to evaluate the consumer in today's economy, it doesn't actually seem like there's a clear indication today that the consumer is completely dead. And if the consumer is not dead, and in fact, some segments of our economy are continuing to spend like crazy, then could we potentially avoid a recession? Now, I want to go ahead and try to find this segment here because I think it's going to be a big deal. Which income groups contribute to GDP the most? So let's go ahead and find that out. And let me see here. Let me write a little note here. So I know we've got GDP by industry. That's so easy to see, but I want to see what incomes contribute to United States GDP. Let's see here. GDP again. Everything is always by sector. I want like by wealth. How about this? How much does the bottom 20% contribute to GDP? You know what? Let's try ChatGPT and see if it could get us into the right area. Trends, income, and wealth inequality, income share. Wow. Why is it so difficult to find? That's okay. We will get to the bottom of it. I do think it'll be very interesting. So, all right. ChatGPT it is. And let's see if we can get an answer because I think it'll be useful to us. So the bottom 10% is 15,660. The bottom 20% a little higher. How about, what does ChatGPT have to say? Wow. According to the World Bank, in low-income countries, the bottom 20% typically contributes less than 5% of GDP, while in high-income countries, the contribution is around 10% rather. So the bottom 10 or 20% contributes about 10%. How about how much does the top 20% or how much does the top 20% of the population by income in America contribute to GDP? See, look at ChatGPT. Now we know some of this is, this is going to be more sort of generic data because we're not going to have the most recent estimates from them. But see, the top 20% of income earners contribute 52% to GDP. Wow, up to 55%. That's really interesting. Okay, so let's go jump into let's add that in to how we think about this. And then I think I had one more thing I wanted to hit here. So, oh, right. Okay, yeah, I had somewhat of a conclusion to this, sort of my thoughts about potentially what's going on. So let's fix that. Okay, here we go. Okay. So now we have the data. The fact is that the bottom 20% of income holders only contribute roughly 10% to GDP. In other words, the bottom 20% of earners are only contributing about basically half of their representative population to GDP, whereas the top 20% of earners contribute about 2.5 times as much to GDP. That is, the top 20% of earners contribute about 55 to 58% to GDP. So, well, wait a minute then. If wealthier businesses and wealthier consumers are still spending, yeah, the bottom 20% is getting whacked, but they're not representing as much of a contribution to GDP. And we're not actually seeing the big waves of joblessness yet. Is it possible that maybe we could avoid ever seeing those levels of joblessness and actually dodge a recession? And in which case, if we dodge a recession, what the hell was all of what we just went through? And this is where I think there are two potential answers. Number one, we just haven't seen the real pain yet. That's probably the default analysis. That, don't worry, unemployment and wealthier spending is just a lagging indicator. As soon as those job losses accrue in the lower levels, the lower income levels, then they're going to trickle up from the bottom. You're going to see those mid-sized businesses and larger businesses stop spending money. When they stop spending money, the entire economy will see even more job losses and we'll be right back into 2008. That's one argument. And it would make sense, but we're not actually seeing job losses accrue at even the lower levels. Nowhere are we seeing job losses accrue. It actually seems like we're still substantially able to get a new job, even if we got laid off from our last one. Maybe at a slightly lower income, but does that necessarily mean we stopped spending? No, of course not. So then the question is, okay, what is scenario number two? If scenario number one is, oh wait, but we're still not seeing the levels of that, then what's the second potential explanation? Well, the second potential explanation is what I call a rejiggering. A rejiggering is where we basically see the entire economy thrown into a blender, mixed up and shaken up like a salad that McDonald's doesn't serve anymore. And you open it up and you get a totally different kind of economy. Consider it a little bit more bluntly. People who used to work in the office pretty much all went to work from home. And then some of those people after the pandemic went back to the office and some stayed at home. And some who wanted to stay at home ended up having to get different jobs. So you saw layoffs lead to those people getting jobs somewhere else. People who went back to the office maybe went to work at a different office. So you get this rejiggering of where people are working. You also get the shift of where people live. People move to COVID boom towns and then potentially move back or out of those COVID boom towns. I've actually talked to people who live in Texas, who moved to Texas during the pandemic, who say, I'm moving back to California. And so then it makes us wonder, well, wait a minute. If a lot of the craziness we're seeing in the economy is just sort of a reshifting, and yeah, we're hearing about these layoffs, but we're not actually getting job losses, is it possible we could get through this sort of consumer spending transition without a recession? And the answer is yes. And so that's what's wild, is looking at the consumer. There are so many negative things we could look at. Oh, tighter bank lending is supposed to hit them. But you know what? Even when I looked at tighter bank lending to research this, you know what I realized? I go, even subprime auto loans, even if 75% of people ended up defaulting on their auto loans because they were a subprime borrower and 3 out of every 4 defaulted, the people lending for subprime autos would still make a profit. It's kind of like the system's just been rigged against poor people. I mean, we kind of already know that. It's the people with assets make the rules, right? The people with the gold make the rules. That's the golden rule after all. So if that's the case, then maybe right now we're not actually going to see this banking crisis turn into any kind of crimp down of lending and therefore this massive joblessness because people can't afford to keep getting by, especially since Bank of America's bank balances are rising. And when you look at Discover, what do they say? Discover's jumping up and down going, we had our best quarter last quarter of people bringing money to our bank and us giving them loans. So yeah, there's some degree of normalization that we're seeing in consumer spend, but are we and also consumer borrowing? But is anything really that reminiscent of 2007, 2008 in terms of the consumer right now? Not really. And so that's fascinating from the point of view of maybe whatever this recession is super nominal or nothing at all. I mean, it doesn't take much to go slightly negative on GDP, right? GDP only has to be negative 0.1% to technically be in a recession if you have that for 2 quarters in a row. But I have to say, studying the consumer here, not that scary. If anything, it actually seems like the first quarter of 2023, things are looking up again. And maybe the real recession was when we had the technical recession in 2022. Pretty wild. So anyway, with that said, if you want to get super powered book summaries and be inspired to maybe check out future books, go to shortform.com/meetkevin. If you go to shortform.com/meetkevin, you can check out super powered book summaries on your phone, through PDF. You could audiobook the summaries, basically. Really great for inspiration. And hopefully you'll check out Shortform by going to shortform.com/meetkevin. You'll get 25% off. Higher and negotiated deal for you. Check it out. Link below. All right. Okay, let's see here. Let's see. What's there? Looks like there's some chat in the commentary here about FHA or whatever. I'm a big fan of people buying with FHA. We live in an economy where savers are punished like criminals. I don't think people are punished like criminals. I just think, yes, saving is disincentivized because you want to see people spend money. Let's see here. You're better off not using FHA financing if you have excellent credit. No, I don't think it has anything to do with your credit score, quite frankly. I think it has to do with your debt to income and your capacity for qualifying. So I don't think your credit matters at all for that. Let's see. Interesting. Some fascinating commentary. I always like looking at the commentary on the weekend. We've got the subscriber commentary here, so it's usually a little bit more, rowdy. Yeah, very cool. All right, let's get to the next topic. So that's on consumers. I have a fascinating take there on consumers. I think it's so interesting to me about how we think we're so certain to go into a recession. And the data that we get is so mixed, if anything, positive. The Bank of America piece was mind-blowing to me, that Bank of America is starting to see consumer excess savings rotate up as opposed to down, right? I mean, that blows my mind. Personal. Let's see. So there's a question here. Let's see here. Somebody's asking, what about personal debt to income ratios? So we can figure that out. Payments. I can tell you personal interest payments. It would be household debt payments, percentage of, let's see here, household debt service payments. Here we go, as a percentage of disposable income. Yeah. All right. So I think that's a good follow up. So good follow up here. Where's that question? Now, here's a follow-up question. What is the ratio of debt to income from 2006 compared to now? Well, we actually have that chart. All we have to do is jump on over to the good old St. Louis Federal Reserve and their beautiful charts, hashtag not sponsored, on exactly this question. So basically, what is the percentage of debt payment that a household is making today compared to their income? Or should I say their leftover income, right? So once you take out housing payments and groceries, now you're left with disposable income. What percentage of debt do people have as a percentage of their income? If the number is higher than 2006, that would indicate more stress, right? If it's lower, that would indicate less stress. And so what do we see right here? Boom. Look at that. So in 2006, we were sitting at about 12.5%. Today, we're sitting at 9.7%. And what's remarkable is it actually flattened over here between Q4 or Q3 2022 and Q4 2022, which is where the data series ends. We should be getting the next Q1 data here within the next few weeks. But it's fascinating because you're not seeing this go back to 2006 levels. You're actually seeing just a normalization to 2019. And so I think people are seeing this spike right here. And they're like, oh my God, everything's so bad. But what if it's just a normalization to trend? Maybe that's actually what we're seeing when it comes to consumerism. So it's really fascinating, and it doesn't indicate a recession. Somebody here says the extra money from stimulus and such has to dry out. It's a slow process, and it will not go away in 1 year. It's a patience game. Yeah, well, the longer it takes, the longer we could potentially avoid a recession. And the indications are that you don't have to have a recession. But I mean, consider what Bank of America told us. If what you're saying is true and the only thing propping up consumer savings is stimulus, why in Q1 of 2023 did Bank of America savings on net rise rather than continue to get drawn down like they did in 2022? Well, it's a sign that people are still able to make money. So you're able to get out and make more income to continue to spend, even though the prices are higher. So again, I don't know that there's a substantial glaring indicator here of this horrible 2008 style recession. It really also aligns with what we're seeing in real estate. I mean, the first 3 months of 2023, real estate has started booming again. I mean, there's a lack of inventory. Prices have started rising again, but there was a lack of inventory last year as well, and prices were falling. So it's really interesting, this potential that maybe things just aren't that bad. Something to pay attention to. Somebody here says, let's just ignore food inflation. I mean, quite frankly, I don't understand why people sometimes make these loaded statements. You're suggesting that I ignored food inflation when I literally spent the first nearly 5 minutes of the consumer segment talking about how people are having to trade down to less expensive food because they can't afford it anymore. Of course, food inflation is a problem. But guess for whom food inflation is important? The bottom 20% of people. And again, how much do they contribute to GDP? 10%, if that. So in other words, we're not here to say those aren't people and they don't have feelings and hardship and that they don't matter. We are here to say that they're facing problems, but that's not indicative of what the rest of the economy is feeling. So, you gotta be careful with the people that just make loaded statements like, oh, but I haven't seen food prices go down. Well, yeah, but that anecdote has nothing to do with the greater economy at all. And it also misunderstands what inflation is, right? Stable prices does not mean prices are back to 2019 levels. It just means they're not rising anymore. Anywho, so we'll end the consumer segment. So let's see here. Okay. Fascinating piece. All right, next thing we got to analyze is, ooh, yeah, this is going to push some buttons. Oh, but it's a good one. So, oh, this one's going to be fun. A little bit of politics. It's the weekend. We got it. We get to do politics on the weekend. That's the rule. All right. So we'll pull this up, and then we will pull this up. Okay. Okay, hold on one second. All right. There we go. Now, this is sure to ruffle some feathers because Tucker Carlson is being Tucker again. Don't get me wrong. I think Tucker knows exactly how to identify what's bothering Americans throughout our country and really highlight how we should be frustrated about the state of certain affairs in our country. And sometimes he hits the nail on the head, but other times he has a tendency of using information and commentary that's not precisely telling the whole story, and unfortunately can sometimes be an outright lie. Now, what I'd like to do is break down what Robert F. Kennedy just said, who just announced that they're running for president. Now, what you need to know going into this segment is I ran for governor in California, and when I ran for governor against Governor Newsom, I ran as somebody who's in the middle. I called myself 5149 JFK Dem. People heard that and they're like, all right, that's the only Dem I'd ever consider voting for. I hear it all the time. What's fascinating is Robert F. Kennedy has the same kind of commentary after he went on to Tucker Carlson's show. People were saying, sounds like a level-headed Dem, somebody who's actually bringing reason back to the Democratic Party. But the problem is the reason we got was a little flawed, actually quite flawed. And so we're going to break that down. In addition to breaking this down, you have to ask yourself, why would a Democrat be invited onto Tucker Carlson's show? And why would Robert F. Kennedy announce his run for president as a Democrat, and one of the first stops he makes be Tucker Carlson's show? Why wouldn't he be showing up on CNN or NBC or some of these other MSNBCs, whatever? Why not show up on some of these more left-leaning shows? Well, I can say from personal experience that the Democratic Party is so rigged and in line with the media. And I'm not saying the Republican Party doesn't have rigging going on as well. They certainly do, okay? But I can tell you with certain, maybe it's just all politics, I can tell you with certainty that when I ran for governor against Gavin Newsom, the puppet basically of the media of the left, what ended up happening? My campaign was often ignored by left media, and yet I sat down on national television on Fox News, Fox Business, KTLA, Newsmax, you name it. All of the right shows wanted to hear from me, but not the left shows. Why though, if technically you're running under the D ticket? Well, there's a reason for that. The right-leaning media realizes the best characters to basically shit on the existing governor or the president are the other people within the party going, this party sucks. We need change in the party. And that's actually what you end up seeing from Robert F. Kennedy here. So I think it's really interesting because I ran a very strong campaign. We got nearly 1 million votes in California, won San Francisco, to change California for the better. Now, obviously, I lost, but I learned a lot. And I have to say, it's really fascinating seeing the similarities play out now on a presidential scale. However, I am still going to address where Tucker Carlson and his guest are misleading America, because it's a perfect opportunity to break down why you've got to think really critically about what you hear from Tucker sometimes. All right, so let's listen in to this segment and see what they have to say.
Tonight he joins us now. Bobby, thanks so much for coming on. So you are, of course, being dismissed as a vaccine nut, but watching your announcement today, it wasn't about pharma even so much as it was about America's place in the world and what do we do about it. If you wouldn't mind summarizing for our viewers where you think we are and what you think we ought to do.
Well, I gave a long speech, Tucker, and thank you again for having me on.
Of course.
And for that very kind of an introduction. I think that the general theme of my speech was this corrupt merger of state and corporate power, which is turning our country into a corporate kleptocracy, into a system of socialism for the rich, and this kind of a cushy socialism for the rich, and this kind of brutal, merciless capitalism for the poor. It keeps us in a state of war. It bails out banks at the same time that last month, the United States government told 30 million people it was cutting their their food stamp checks by 90%. It took 15 million people off of Medicare. The same month, it gave $300 million to the Silicon Valley Bank.
So let's pause right there. So far, all three of those claims that, I hate to say it, but Robert F. Kennedy just made were actually highly misleading, extremely misleading. Let's go in reverse order and actually address these claims. He just mentioned that we gave $300 billion to Silicon Valley Bank. That is wrong. The FDIC spent about $20 billion to bail out Silicon Valley Bank and about $2.5 billion to bail out Signature Bank in New York. That's not $300 billion. That's $22.5 billion. And it's from an insurance corporation, which will probably end up billing other banks to help make up that loss. Now, don't get me wrong. I don't think that's right. I think there should have been more losses at Silicon Valley Bank so that way the rest of the banking system doesn't have to pay for that $22.5 billion. But let's be clear, the government didn't pay that $22.5 billion. Ultimately, it will be other banks that pay that $22.5 billion. Now, where the line gets blurred is that, yes, technically we established a liquidity facility via the Federal Reserve backstopped by taxpayers for Silicon Valley Bank. In other words, in plain English, we gave Silicon Valley Bank a loan that was guaranteed by taxpayers. That is true. But after that money was no longer needed, that liquidity was no longer needed, and the assets were liquidated at Silicon Valley Bank, which is still in progress now, the estimates are the total losses will be $22.5 billion, and not for taxpayers, but instead other banks. That's a really big deal because when you're saying Silicon Valley Bank got a $300 billion payment, it's wrong. Yes, they got loans that were repaid via the assets that they have and are being repaid by their assets they have, but it's very misleading. So it's important to break down what is actually happening. In addition, this idea that 30 million people had their food stamps cut via the SNAP food programs is wrong. What happened was a pandemic era, a COVID stimulus era food stamp program, SNAP benefit program benefits ended, and other programs stepped into their place. The same is true for the 15 million people off of Medicare or Medicaid. Before their crisis, for example, people would regularly lose Medicaid coverage if they started making too much money. Remember, aid is for poor people, care is for old people. Aid, poor, care, old. Just remember that. Anyway, if you start making too much money, guess what? You don't qualify for the programs anymore. You get kicked off the programs. Duh. That's the point of a social safety net, is that once you don't need the social safety net, you get your ass off of it. So the money's there for other people. Well, what happened during COVID? The government said, don't worry, we're not kicking anyone off. We don't care how much money you make. Now, Medicare and Medicaid are actually checking if people qualify again, just like they always have in the history of Medicare and Medicaid. So, ending a COVID pandemic stimulus era program that was designed to be temporary is not kicking people off. It's just going back to checking, hey, do these folks still qualify? So, this is really misleading to say this. And I think it's worth highlighting some of the differences here, but it gets worse. So let's keep listening.
And tapped up the cost of the Ukraine war to 113 billion. We're sending 113 billion to the Ukraine. The entire budget of EPA is 12 billion. The budget of CDC is 11 billion. We have 57% of American citizens could not put their hands on $1,000 if they have an emergency.
These things are true. But before the pandemic, under the Trump administration, that statistic was exactly the same as well. 57% of people don't have $1,000. This is something you could easily Google. It fluctuates between 56 to 57% all the time. That's not a surprise. Yes, it is true. The EPA's budget is $12.08 billion and the CDC's budget is $11.581. Yes, we did just spend upwards of $113 billion in Ukraine. This is true. So far, this is correct. Let's keep listening.
A quarter of our citizens are hungry. So we're cutting welfare and food stamps by 90%. And we're paying and we're bailing out the bankers. We're paying for a war that, we can't afford. And with the way that we do this is by printing money. We've printed 10 centuries of money in the last 14 years. And that caused.
That, by the way, is also pretty misleading, just unfortunately, because obviously $10 was worth a whole lot more in 1900 than it is today. Just like a gallon of milk was 1/3 of the cost in the 80s compared to what it is today. Now, of course, part of that is because of the expansion of the money supply, basically inflating away the value of the dollar. But obviously, on this finance channel, we make it clear that we're not here to shill the dollar or tell you to have cash. Cash is stupid most of the time. Right now, it makes a nice yield and you could use it as a hedge when asset values are falling. But the best thing to have in your life to build your wealth are assets, businesses, stocks, and real estate. Most important. So yeah, as those inflate away, guess what? Asset values actually go up in nominal terms compared to the dollar. But anyway, I don't know that terribly matters so much, but that's okay. Let's get to the real data here, which gets a little worse.
Inflation, which raises food, which is a tax on the poor.
True.
So, we've raised food prices for basic foods like chicken, dairy, and milk by 76%.
Yeah.
In the last 2 years. And now we're cutting people's food stamps and bailing out banks the same.
Again, though, this argument is flawed, right? Yes, food prices have gone up. But then to say, oh, we're taking people off of the social services programs because we're checking if they still qualify, it is not a fair comparison. You can't link those two things and then misappropriate the fact that $300 million or $300 billion went to Silicon Valley Bank when that's not true.
It doesn't make any sense. And we need to get rid of this kind of corporate control of our government. It comes from this, our democracy is devolving into kind of a corporate plutocracy.
I would think that what you just said, and I'll just be honest, I agree with most of it. But even if I didn't, I would think, boy, that's a really interesting thing to say. You have a coherent worldview. You've written a lot of books on these topics. You've clearly thought about it. You're not in it for the money. So don't these issues deserve a wide hearing before the public entering a presidential year? It seems to me that they do.
I would think they would, and particularly the issues of war. And, my son went over and fought in the Ukraine. As I said today, I think people, the major doyens, sort of the most respected diplomatic gurus like Henry Kissinger and Jack Matlock and Larry Wilkinson have all said the Ukraine war is a huge problem for our country because from a geopolitical standpoint, it's driving the Russians close to the Chinese, which is the worst thing for us. But we're there for the right reasons because we have tremendous compassion for the Ukrainian people and the illegal invasion, the brutality, and also their valor and their courage. My own son was serving over there. He joined a special forces unit as a machine gunner. He fought in the Kharkiv offensive. Americans care about the underdog. They care about that kind of suffering. But the question is, why are we in the Ukraine? Because Lloyd Austin, the Secretary of Defense, said that we're there to exhaust the Russians. President Biden has said that we're there to deplatform, to depose Vladimir Putin. And if that's why we're there, and we're killing a lot of Ukrainians as pawns in a proxy war between two great powers. Here's one last thing I would say. Nobody talks about this. There's 14,000 Ukrainian civilians who have died, but 300,000 troops. The Russians are killing Ukrainians at a 7-to-1 to 8-to-1 ratio. They cannot sustain this. What we're being told about this war is just not true.
Okay, this is problematic. It's also problematic because I see somebody in the comments saying the limits for Medicaid eligibility haven't gone up. False. There are inflation adjustments for them. They have gone up. They've expanded widely. In fact, the poverty level line has actually moved up from limits of 100% of the poverty line to 138% of the poverty line in some states. So be careful about that. We could go through some of these statistics. But what was just mentioned is really problematic because here, Robert F. Kennedy suggests that 7 times as many Ukrainians are dying as Russians are dying in Ukraine, which is quite fascinating because just 5 days before Robert F. Kennedy's interview with Tucker Carlson, listen to what Tucker Carlson said on his show.
The second thing we learned from these slides is that despite direct U.S. involvement, Ukraine is in fact losing the war. 7 Ukrainians are being killed for every Russian. Ukrainian air defenses have been utterly degraded.
Interesting. The same statistic that the Robert F. Kennedy guy just used to tell back to Tucker Carlson was used 5 days prior on Tucker Carlson's show himself. So, first of all, Robert F. Kennedy was wrong on quite a few things. He's wrong on Silicon Valley Bank, he's wrong on the food stamps program, and he's creating these correlations that are unfair to what's actually happening in the economy. But now we're looking at, wait a second, you're saying 7 times as many Ukrainians are dying. Did you just get that stat from Tucker Carlson? And if you got it from Tucker Carlson, where did Tucker Carlson get that stat from? Because that also doesn't appear to be true. So the best thing to do here is try to understand, where could this data have come from? If Tucker Carlson is saying 7 times as many people died or Ukrainians are dying, where's he getting the stat from? Obviously, Robert F. Kennedy is reiterating it. Whether he learned it from Tucker or somewhere else doesn't matter so much. But what matters is what the reality is. And the reality is the following. This is the specific slide that they are referring to. Now, I want you to pay very, very clear attention to this segment down here. 16 to 17,500 killed in action Ukrainians. Pay attention to this. Now, I want you to see the piece that was leaked, quote unquote, leaked after being altered on Twitter. Take a look at this. The numbers were changed from 16,000 to 17,000 to 61,000 to 71,000. Now, I want you to closely examine this for a moment. Look at this right here. These numbers were 35 to 43 for Russians, and those numbers were actually reduced to 16 to 17.5. But what I really want you to look at how unaligned the text is. Well, let me draw a line under the 16.5K. And look how it cuts off the rest of the sentence. This segment was clearly edited, not only because of that, but look at the period here and then the 5, right? We could see the 5 right here. Look at how large the gap is between the 17.5 and the 0.5, which when you compare to over here, you do not have that large of a gap. This actually looks relatively normal compared to this massive gap that you see over here. So we know these documents were altered, and the documents were altered to suggest that Russia is losing a lot fewer people and Ukraine is actually losing a lot more. This was a Russian propaganda tool. But wait a minute. This isn't a 7-1. Sure, but you have to Tuckerify this. And this is where, wait a second, folks. We have to remember we're listening to Tucker Carlson. The truth isn't the most important priority. Views are the most important priority. And that's okay. We know that about Tucker. He's sort of summarizing the sentiment that we're feeling. So is the RFK guy, right? Look, people are pissed that food is more expensive. People are pissed that we're spending this much money in Ukraine and a fraction of that on our own Environmental Protection Agency, right? Why does that all seem so backwards? We have plenty of problems in America. Why spend all this money over there? There are plenty of sentiments we could totally agree with. But wait a minute. When we actually try to figure this out, how could you possibly get 1-to-7 ratio from this? Through laziness, folks. That's how. Look, if you take 16,000 and you round it down, what do you get? You get 10,000, right? You just take the first digit. All you have to do is take the first digit, 10,000, and then take the first digit on the lower side over here, on the Ukrainian side, but take the first digit of the higher number, 70,000. Oh, look at what you have. A 7-to-1 ratio. That is 7 times as many Ukrainians are dying as Russians in a doctored false piece, in a Russian propaganda piece. There's a reason why Tucker Carlson is the most famous American guest on Russian propaganda television. The Russians love Tucker because Tucker says stuff that makes the Biden administration look bad. And there are plenty of reasons to make the Biden administration look bad. Okay, I'm not here to defend the Biden administration. But when you use Russian propaganda in your own stories, and then your guests start regurgitating that Russian propaganda back to you, what you get is an uninformed electorate that gets unnecessarily pissed off based on false information. And it's really dangerous. There needs to be fact checking for Tucker Carlson shows. It's exhausting, though, because it seems like it's every day. You have to kind of go through and go, where the hell did that stat come from? Oh, the doctored stuff Russia is using as propaganda. Oh, and now it's like a virus. It's like Tucker says it, pronounces it using false information. And then everybody else is reiterating the Tucker comments. It's a big problem. So the best thing I could suggest now is if it stresses you out, get life insurance in as little as 5 minutes by going to metkevin.com/life. metkevin.com/life, and you can Apple or Android pay for life insurance in as little as 5 minutes. On top of that, if you want to get super-powered book summaries, make sure you go to shortform.com/meetkevin. Get 25% off signing up for Shortform. Try them out. Give them a trial. Super easy to audiobook or PDF read super-powered summaries of amazing books and get inspired. All right. Next. All right. We have a zapis to go through. This is a good one. Let's do this one. Oh, man. We'll do this one, and then we'll do a Fed piece. Because I do want to get back to the Fed as well. And both of them quite useful. Well, one's interesting, the other one's more useful. All right, let me pull this up. How y'all doing in the commentaries yet? The dance for the intro. Oh no. All right, let's see here. Oh yeah. This one's juicy. but it will take me just a moment to get up here. You know what we can do in the meantime? Is let me pull this, and let's see what they're saying over here. Oh, I found it. There we go. I'm just curious what they're saying over here. Oops, not there. There.
In the lower courts at this point. So not surprising. We thought probably there would be a dissent or two. So we know that Justice Thomas dissented, but Justice Alito wrote his dissent and basically said, I don't think that the people who are pushing for access to the pill have shown that they will suffer any real harm. The Fifth Circuit, that next step below the Supreme Court, has expedited this whole thing. So they will actually hear arguments on this May 17th.
This whole abortion pill thing is pretty crazy. I think it's going to be a lot bigger of a deal in the 24 election. And it's crazy because there's so many important things. I'm not saying that there isn't some importance in figuring, getting this Supreme Court Roe v. Wade situation ironed out. But boy, just there's so much going on. It's wild. All right. So, yeah, let's do this one. Well, this is pretty wild. Y'all know the My Pillow guy that shows up on Fox News like 27 times in an hour? Now he's complaining that My Pillow 1.0 isn't actually as good, and you should buy his My Pillow 2.0 because he's found some new proprietary threads. Yeah. Well, anyway, this guy made an argument all throughout 2021 that he would pay $5 million to anyone who could prove the material evidence that he had was not about Chinese interference and not from the presidential 2020 election. In other words, Mike Lindell set up a contest and said, we believe there was election fraud and we have evidence to say that there's election fraud. And anybody who could prove that our evidence is not election fraud, a material from the election, we will pay them $5 million. So what ended up happening? Well, this computer forensics expert decided, who was a Trump voter, two-time Trump voter, decided to sign up for Mike Lindell's contest. He met the qualifications, showed up to the contest, and got the data that they were alleging was provable election fraud data. In fact, Mike Lindell went as far as calling the election fraud data that he had, that he revealed at the cyber symposium, he called it. He said the data would reveal data that was like watching a movie of election data and specifically election fraud in real time. That was the argument that Mike Lindell made, and he put $5 million on this. He says, when we show them these packet captures, we're going to just give them out to all the cyber guys so they can have their own guys go, how many votes were flipped here in Tampa or in this area or in that area or whatever. Well, the computer forensic scientist who ended up getting the data ended up looking at the data and going, this is not from the 2020 election. And that is a very specific word. See, look at this. The rules provided that to win the $5 million contest, the participant must prove, quote, that the data Lindell provides and represents information from the 2020 election. And if you can prove that it does not reflect information from the 2020 election, you win $5 million. Now, this document is the arbitration award agreement for the person who ended up winning this dispute with Mike Lindell. We'll talk about the result in a moment. But what I want you to pay attention to is this word right here, from. This was the word that changed the entire case. The arbitration board argued that all somebody had to do to win the $5 million was prove that the data they were given was not actually from the 2020 election. So in other words, if you get data and you look at it and you can't link it to the being from the election, well, then that evidence is not from the election. And if somebody can prove it's not from the election, then Mike Lindell loses $5 million. Now, Mike Lindell was using this as a ruse to prove that there was election fraud because nobody could disprove it. By the way, it's worth noting that is a logical fallacy known as shifting the burden of truth. The burden of truth of somebody alleging voter fraud is on the person alleging voter fraud. Okay, you think there was voter fraud? What evidence do you have that has not already been disproven or otherwise that there is voter fraud? And if you're just saying, well, prove to me that there wasn't voter fraud, what you're doing is you're shifting the burden of proof. It is an illogical way of constructing an argument. Unfortunately, we don't teach logic in our schools generally, so most people make logical fallacies in the way they argue. That's what I try to do on my channel, is try to unwind the disasters of our educational system. But anyway, take a look at the files that were gotten. First, C-extract MP4. This would be a video file on how to basically extract information from certain code files. And this states here that the information had nothing to do with the 2020 election, something the other side, Mike Lindell's side, actually agreed with. Okay, fine. Next, Chinese source IPs. According to the person who was trying to win the $5 million, this file included IP addresses and basically a ranking list organizing them from basically like 1 to 100. And there were no packets of data, despite Mike Lindell suggesting they had packets of data. Instead, all this person got was a text file with a list of IP addresses that were ordered. And that can't be used to show any kind of packets of Chinese or interference data from the election because there are no packets of data. They're literally just IP addresses. Then we get file election process taxonomy PDF. But this is literally just a PDF on how voting machines work. Also had nothing to do with election fraud. Final result, actually it says final realt 2020 hex TEX. This file was displayed and it indicated no readable data. A cipher had been placed on the file, and it basically was just unreadable or perhaps just a bunch of gibberish. Okay, so Mike Lindell is literally using gibberish in a text file to claim that he has election fraud data that he'll pay somebody $5 million if they could say is not from the election. Another one. Files analyzed below, no packet data. Target machine ID. No packet data, therefore cannot be from election data. Basically, more gibberish-rich text files. Very large spreadsheet. Spreadsheet does not include any identifiable package data. Instead, just includes source and target IP addresses. Well, that doesn't mean anything. I mean, you could literally make a list of IP addresses all day long. I can make up IP addresses all day long. Tool known as Wireshark, which is commonly used to open bin files, was only able to return an error message. In other words, nothing found in these bin documents. Now, the other individual, the other side, testified that he was able to do so during the hearing. He was able to open, like Lindell's side is like, well, we were able to open it using the program we said we should use during the testimony, during the hearing. But then they didn't actually present what the results were. So the arbiters and the arbitration board is like, what is this? Like, you all say there's voter fraud and election data, but you literally have no data so far in a $5 million contest. So the guy went to claim his $5 million, and Mike Lindell's company's like, F you, man, we're not paying you $5 million. So we took it to arbitration, and the arbitration board decided that Mike Lindell has 30 days to pay $5 million, and there's the potential that Mike Lindell's contest was a total fraud, which it probably and realistically was, but an arbitration board is not a criminal board, so they're kind of going to drop the whole fraud allegation because, again, they're not a criminal board. So, Mike Lindell, you owe $5 million to a computer scientist who basically proved that all of your arguments were bullshit. You put $5 million to shift the burden of proof to suggest there's election fraud, and the best you could come up with were files of gibberish. And that just cost you $5 million. Congratulations, Mike Lindell. You're a loser. Literally, you just lost $5 million. Okay. So that's a whole lot of pillows. Oh, that's a good one. That one takes the cake. Oh, dear. All right. Next up, we got a... This is so ridiculous. So ridiculous. All right. Now we got to do... let's talk about the Fed. All right. Oh, yeah, I have this up. Hold on. Let me make sure this is still up. Please. Yes. Yes. Got it. It's a lot of pillows to cry on. Both parties are liars. It sucks, man. It's all politics. All right. Okay, here we go. So let's jump into, the Fed and Mona Lisa. Oh, yeah, that sounds raunchy. Now we got to talk about the Federal Reserve, the next hikes, and the Mona Lisa. Yeah, that's right. We're literally going to talk about the Mona Lisa effect in regards to what the Federal Reserve may be up to. But first, we have to recognize that so far, earnings are doing pretty damn well. In fact, expectations were that earnings would miss pretty miserably in Q1. Except what have we noticed so far in Q1? Well, we've actually noticed that American saving balances are actually rising. Bank of America noticed American savings declining throughout 2022, and everybody's thinking, oh my gosh, as soon as they run out, we're in a recession. And what happened? First quarter of 2023 savings balances started to go up. What did we see 3 days ago before some of the recent earnings we had? Well, we had Barclays provide commentary that European earnings per share results came in above 5% over consensus, 5 percentage points over consensus. And in America, they came in 6 percentage points over consensus. Today, after this week's of earnings, what do we have? Bloomberg. Better than feared earnings has analysts rethinking projections. Roughly 20% of the S&P 500 has reported. 77% has topped expectations. Quote, it's still early in earnings season, but the results so far are coming in strong enough that some on Wall Street are starting to wonder if they were too pessimistic. Roughly 20% has beat by 77%. Large number of names that have reported so far beating, way higher than expected. The overall strength in results has Bank of America strategists pondering whether 2023 full year EPS targets are too low. And maybe because investors are forward looking, a lot of this, quote, earnings recession fear has already been priced in. And so maybe this whole earnings recession is a bunch of clickbait, where instead we should be focused on what's actually happening, which is a freight recession. Look at J.B. Hunt. J.B. Hunt sees a massive collapse in freight demand. They've got too many trucks, too many containers, not enough stuff to ship. It's so bad that a lot of companies like Procter & Gamble are now cheering, going, last year when prices went up and our costs went up, we raised prices on the normies and the consumers. We made it more expensive for people to buy Tide detergent. Today, we don't have to raise prices anymore, but freight costs are plummeting, so we're making more money once again. Thank you very much. That's corporate America for you. It's kind of disgusting because prices are still high, but it shows you some of those pricing pressures are going away. Well, at the same time, many companies' earnings are actually substantially better off than expected. And so what is this Mona Lisa effect? Well, The Economist today had a phenomenal breakdown of something known as fumato and the fumato effect. Basically, the fumato effect, spelled SFUMATO effect, represents a gradual change or sort of a haziness in a picture or potentially an outlook. And the reason this relates to the Mona Lisa is because people suggest that, hey, every time you look at the Mona Lisa, you might not be entirely sure what's happening. In fact, you could be a little bit confused by, well, really, how the Mona Lisa looks and how to interpret it. And it feels like every time you look at the Mona Lisa, it seems a little different. That's an argument known as the fumato effect. And the fumato, it sounds like a lot like tomato, depending on how you want to pronounce it, is exactly what we could potentially be seeing with our economy. Consider what The Economist said. The economy is facing the fumato effect. We are in a situation where it seems like week by week we get different analyses on, we're going for a hard landing. No, we're going to go for no landing. No, we're going to go for a soft landing. What the F? Why isn't the data clear? Well, that's actually the problem. See, today, our economy has been so rejiggered that seasonal adjustments are virtually impossible to data to help us understand what's actually happening in the environment. We don't know because we're trying to adjust a post-COVID environment and line it up with a pre-COVID environment. But we barely had work from home pre-COVID. Yeah, it started to gain popularity, but 10 years ago, it was embarrassing to say you worked from home. What a difference that is today. And so economic literature is having a massively difficult time in adjusting any data to let us know how good or bad are things really right now. In fact, if you look at soft data expectations, like inflation expectations or expectations of poor economic conditions, you actually have pretty ugly data right now. Soft data is telling us, oh no, things are bad. I mean, consider some of the leading indicators, leading economic indices from the Consumer Conference Board indicating an unexpectedly large drop. Half of Americans feel like their financial situation is worse off this year than it was a year before. Last time we had that kind of big drop was the Great Recession. And so now people are scratching their head going, okay, so soft data is coming in pretty soft and blurry. But hard data like unemployment is actually coming in strong. And The Economist says, fumato, we just don't know. In addition to that, you have this idea that, hey, wait a second, if all of a sudden you have these weird blurry reports, is there a possibility that that is being enhanced by fewer people responding to your surveys? Companies are usually invited, and so are consumers. They're usually invited by the Consumer Conference Board, by the Bureau of Labor Statistics, ISM, and so on. It's the Institute for Supply Side Management, and so on. And what you end up having is less businesses responding, and the response rates for these surveys plummeting. So at the same time as you're looking at a blurry adjustment of post-COVID world where people might be more interested in traveling and entertainment and working from home more compared to a pre-COVID world, you get really, really hard comparisons. But in addition to that, you're getting less data because for some reason people are responding less. Now, some people say that, well, companies might be less inclined to respond because things are so bad. In other words, the zombie companies are like, I'm not responding to that because I'm embarrassed to say how bad things have gotten for our business. Other people say businesses aren't responding because they're busy. They're busy making money. They had plenty of time during COVID and now they're busy and they don't have time to respond to all your stupid surveys. So The Economist is making the argument that, hey, maybe things are so blurry that the Fed is indeed going to gear up for a pause after May. In fact, they make the argument that Mr. Bullard is one of the remaining hawks. He's one of the people that says we should get rates to 5.5 to 5.75. But guess what? He's not actually an FOMC voter. So he literally has no say as to where we're going with rates is 5.1 or 5.5 or 5.7%. He's not voting. His talk is cheap. Whereas other hawks, like Loretta Master, she's generally pretty dang hawkish. What's happened with Loretta Master? All of a sudden, she's coming out and suggesting, we're closer to the end, and we just need to get a little bit above 5%, and then we're probably good. We're closer to the end of the tightening cycle than the beginning. Well, duh. But still, what do you have? You have a lot of publications from Bloomberg and Barron's and The Economist suggesting the Fed might end up being done after May. Now, TBD, if we end up getting hot inflation reports between, the next Fed meeting here at the beginning of May, May 3rd, and June 14th, we'll actually be getting 2 CPI reports between that period. The April one that comes out in May, and then, of course, the June one, the May one, which comes out in June. 2 reports. We won't have those reports for the next meeting. But if those continue to reiterate at least some degree of softness and no runaway inflation, Fed might end up being done. And the pause might come just as earnings actually aren't coming in that horribly. In other words, maybe the Fed is actually driving us towards that creepy and potentially eerily possible soft landing, which I think would probably get Jerome Powell's face up on Mount Rushmore if he's able to land this economy without a recession and inflation goes away. And inflation basically ends up proving to be transitory. It'd be pretty remarkable. But it's pretty insightful because it suggests the data we're getting today overall just isn't that useful. Now, what is useful is getting superpowered book summaries from Shortform. Go to shortform.com/meetkevin, and you can get 25% off audiobook or PDF summaries of books that you might be interested in buying in the future. Or you can just do the summary, the superpowered book summaries if you want, but a lot of people get inspired to end up going to the bigger books. And the content that you get in just the superpowered summary is amazing. So check it out by going to shortform.com/meetkevin to use that 25% off coupon. Okie dokie. So that is a little bit on the Fed there. Anyone got any questions? Then we're going to go. Let's see here. What we got? I've talked about Saudi and the dollar like 4 or 5 times in just the last 2 weeks. Just type into YouTube, Meet Kevin dollar, and you'll see it. I talked about the credit score mortgage 2 days ago. Just you could see that Biden housing. What do I eat for breakfast? Coffee. Argentina. Let's see here. I haven't seen that about the dollars. It'd be nice to see where. Oh, here we go. Oh, this is just a tweet. I would be careful about that. This person didn't provide. It's a crypto Twitter. Where's their evidence? Let's see here. It's hidden behind a paywall, so you can't even you can't even fact check this guy. Yeah. So I'm just seeing from Reuters some pressure to sell dollars, but I'm not seeing anything about running out of dollars. And this sounds like nonsense. But I mean, I'd like to see, I'd like to see some actual evidence on what you're talking about here. According to Ray Dalio, Schiff and Richard Wolff, a crash is coming. Well, yeah, I mean, they say that every day. PJ's under. No, I don't wear anything that you don't see on camera. Everything I'm wearing, you could see right now. Trust me, bro, because they need another headline. Yeah. You know, I talked about Sudan just the other day and African relationships. You can watch that. No, I don't see myself teaching in college. Okay. Dude, anonymous hype man, you're spamming so much. This is why we don't do poverty chat. The spammers come out. All right. Now you're getting a timeout. You're in timeout. Kendall interview was excellent. Yeah, if you haven't seen the Kendall interview yet, make sure to check that out. That was cool. That was just last night. I posted that. At what point are Enphase Taiwan semiconductor overpriced? You know, it's always difficult to say. You know, the chip sector, the entire chip sector is going through a rough time. Their pricing power is at the moment weaker than it has been in the past, and than it's expected to be in the future. And you could see that as an opportunity to build your exposure to those stocks or not. So it depends. Kevin, you're wrong on Google. They're going to steamroll OpenAI within the year. I mean, look, don't get me wrong. Like, I like Google. I'm a big fan of Google. I use Google Admin. I would love to see Google succeed, but so far it sounds like they're panicking and failing. It's just the reality. So I'm just reporting what it is. And I wouldn't touch Google with a 10-foot pole because I'm not gonna speculate on if I think they'll be able to have a product that's successful. I like betting on products that I know are successful. You know, what happens in the short term is up and down, you know, duh. But products that are successful, Apple products are successful. Taiwan Semiconductors, NVIDIA, AMD, Tesla, these products are successful. ASML Machinery, successful product. Bill.com, successful product. You know, these are all stocks I have exposure to. So, well, obviously, I mean, I'm to some degree biased, but there's a reason I'm in them. Whereas Google has an uncertain product right now. They have a product that's disappearing. You know, when you look at the financials, you should be quivering looking at the financials at Google. Quivering. It's just not good. You know? And I've written this down before. Who actually benefits from AI? The customer and businesses do. Do we think Google's going to be able to benefit from it? I don't know. We don't know. But we know that like 80% of their top line revenue is from placement and search. All of that's at risk. All of it. All of it's at risk. That's scary. You know, if you have 10% of the search that you used to have, you're going to run into some big problems when AI starts reducing your need to search at all. You know, that makes me extremely nervous for the future of Google. So we'll see. You know, maybe they can figure it out. Maybe. Yeah, it seems like people they keep making money because the job loss is just people keep going to new jobs. It's kind of wild. As long as you can get another job, it doesn't matter so much, eh? Google needs to lay off 80% of their workforce like Twitter did, lean up and get mean and rebuild. I mean, that sounds terrible because there are just so many people that work at Google, but yeah, I mean, you never know. If they don't need the people anymore, they don't need the people anymore, you know? Rick Schmidt says you're squandering your shilling skills. What does that even mean? So I'm not doing enough shilling? Because squandering means doing poorly at something, right? And you're saying I'm squandering that, so I need to improve those skills. So you're saying I need to shill more? Okay. Hey, check out the programs on building your wealth link down below. No, I think Rick doesn't know English very well. Because I think Rick was trying to be offensive, but I think he just walked into a door. I mean, maybe the door popped out of nowhere. You know, I don't know. I think Rick done screwed up over here. It's kind of like, nah, never mind. Rick has been smearing the channel for a while now, says Ken. Well, it's the first time I see Rick, and he sounds like a dummy. That sucks. I mean, it's okay to be dumb. I could still love you, and we could still have beer if you're dumb, but like there should be like a label. Like an IQ label. We could like do like, you know, we could put like a 69 next to your name or something. Let's see here. Google knows the idea about AI like ChatGPT taking away jobs ain't actually good. You need programmers. Yeah, of course you need programmers to be able to respond to AI failures and to check what AI is doing. But you have to remember, Google is assigning like 170 people to their Magi project to fix AI, not 160,000. You know? Rick Schmidt says, I can't type that fast, but you clearly get it. No, I didn't clearly get it. But what's incredible is it took you 2 minutes to type 8 words. I think we're going to have to demote your IQ from 69 to 49. Are you okay, Rick? It's all good. It's all good. All right, I'm going to go now. I'll see y'all in the next one. Goodbye.